Hello, good morning. Welcome to an Eltoma Corporate Services webinar. Thank you for your participation today. We hope you find this webinar informative and we look forward to your comments and questions. Please let me know if you have problems hearing me because there are usually problems with the connection and excuse any inconvenience. You can always leave us your questions and comments on the chat box on the left. My name is Alvaro Rivero. I'm legal specialist at Eltoma Corporate Services, and I will be presenting the general aspects of cryptocurrencies for you today. I hope you find this webinar informative, and if you need any further assistance on this or other related matters, please do not hesitate to reach us through our website. All right, let's begin. The agenda for today is basically the definition of cryptocurrencies, where we will cover some of the definitions issued by a few regulators and we will provide the general technicalities of cryptocurrencies. We will talk about cryptography, blockchain, the distributed ledger technology, and a legal approach where we will discuss the regulatory approach towards cryptocurrency around the world and with a special focus on key jurisdictions. And we will conclude with the regulatory outlook for the future. So what are cryptocurrencies? Cryptocurrencies or virtual currencies in general are defined as a digital currency in which encryption techniques are used to regulate the generation of units of currency and verify the transfer of funds, operating independently of a central bank. I recommend to all to read the paper of Bitcoin, a peer-to-peer electronic cash system by Satoshi Nakamoto for a better understanding. Regulators have issued their own definitions. For example, the IRS, the Internal Revenue Service of the United States, has defined cryptocurrencies as a digital representation of value that functions as a medium of exchange, a unit of account, and or a store of value. For the IRS purposes, cryptocurrencies are treated as property and will be taxed under tax law of the US. We will explain more about this on further slides. Furthermore, the Financial Action Task Force, FATF, of the United Arab Emirates provided the most detailed definition found so far, where, in summary, it declares that virtual currencies, a digital representation of value that can be digitally traded and function as one, a medium of exchange, and or two, a unit of account, and or three, a store of value, but does not have a legal tender status. For example, when tendered to a creditor, is a valid and legal offer of payment. It is not issued nor guaranteed by any jurisdiction and fulfills the above functions only by agreement within the community of users of the virtual currency. Virtual currency is distinguished from fiat currency or real money backed by a national currency, which is the coin and paper money of a country that is designated as its legal tender, circulates, and is customarily used and accepted as a medium of exchange in the issuing country. It is distinct from e-money as well, which is a digital representation or fiat currency used to electronically transfer value denominated in fiat currency. E-money is a digital transfer mechanism for fiat currency. We can conclude from both definitions that virtual currencies have fulfilled its functions only by agreement within the community of users, and is different from e-money, as e-money is an electronic representation of fiat currencies used electronically. We can agree that cryptocurrencies are a representation of value that is secure through cryptography, a key element that we will describe shortly. Defining cryptography and its particularities will require an extensive length of description and study. For our purposes, we will simplify the definition of cryptography. In simple words, cryptography is a tool for protecting information in computer systems through encryption, often through complex mathematical algorithms. It provides a mathematical solution for computer systems security that uses a mathematical protocol composed by hash functions, which is a system of inputs that applying the hash function, one will obtain an output. Only when one has obtained the output value, one is able to record the information into a ledger that will be later inserted into a blockchain. The ledger is an information registry of transactions and a combination of ledgers form a block. This block is part of a chain of blocks of ledgers secured by cryptography, also known as blockchain. The ledgers are recorded by several independent people at the same time through what is called the distributed ledger technology, and they can submit their ledgers in the form of blocks into the blockchain by applying the hash functions and solving the input data and obtain the output data correctly. This operation receives the name of mining, which is rewarded in cryptocurrencies such as Bitcoin into their accounts, better known as wallets. Distributed ledger technology is one of the most relevant aspects of cryptocurrencies. This technology is most likely to become part of key services such as insurance, banking, even KYC and compliance-related procedures. Distributed ledger technology is a digital system for recording transactions of assets in which the transactions and their details are recorded in multiple places at the same time. Unlike traditional databases centrally managed, distributed ledgers have no central data store or administration functionality. Understanding cryptography. While I was working on research necessary to find out more about cryptography itself, I found the different applications that cryptography has, how it has been used for many years now. As a legal professional, it was unlikely for me to come across this interesting topic. Thanks to the importance that cryptocurrencies had raised lately, I've become aware of cryptography and its peculiarities. As we mentioned before, cryptography, in simple words, is a mathematical solution for computer system security that uses a mathematical protocol composed by hash functions. In more detail, cryptography is a method of storing and transmitting data in a particular form, so that only those for whom it is intended can read and process it. Cryptography is closely related to the disciplines of cryptology and cryptanalysis, topics we will leave for further webinars. Cryptography includes techniques such as microdots, merging words with images, and other ways to hide information in storage or transit. In today's computer-centric world, cryptography is most often associated with scrambling plaintext in ciphertext, a process called encryption, and then back again as decryption. Individuals who practice this field are known as cryptographers. Cryptography is directed to protect confidentiality, integrity, non-repudiation, and authentication. Confidentiality, meaning the information cannot be understood by anyone for whom it was intended. Integrity, information cannot be altered in storage or transit between sender and intended receiver without the alteration being detected. Non-repudiation, the creator sender of the information cannot deny at the later stage his or her intentions in the creation or transmission of the information. Authentication, the sender and receiver can confirm each other's identity and the origin destination of the information. Procedures and protocols that meet some or all of the above criteria are known as cryptosystems. Cryptosystems are often thought to refer only to mathematical procedures and computer programs. However, they also include the regulation of human behavior, such as choosing hard-to-guess passwords, logging off unused systems, and not discussing sensitive procedures with outsiders. The word is derived from the Greek kryptos, meaning hidden. The origin of cryptography is usually dated from about 2000 BC, with the Egyptian practice of hieroglyphics. This consisted of complex pictograms, the full meaning of which was also only known to an elite few. The first known use of a modern cipher was by Julius Caesar, 100 BC to 44 BC, who did not trust his messengers when communicating with his governors and officers. For this reason, he created a system in which each character in his messages was replaced by a character 3 positions ahead of it in the Roman alphabet. In recent times, cryptography has turned into a battleground for some of the world's best mathematicians, and computer scientists. The ability to securely store and transfer sensitive information has proved a critical factor in success in war and business. Because governments do not wish certain entities in and out of their countries to have access to ways to receive and send hidden information that may be a threat to national interests. Cryptography has been subject to various restrictions in many countries, ranging from limitations of the usage on export software to the public dissemination of mathematical concepts that could be used to develop crypto systems. However, the internet has allowed the spread of powerful programs and, more importantly, the underlying techniques of cryptography, so that today many of the most advanced crypto systems and ideas are now in the public domain. Blockchain is a type of distributed ledger for maintaining a permanent and tamper-proof record of transactional data. A blockchain functions as a decentralized database that is managed by computers belonging to a peer-to-peer network. Each of the computers in the distributed network maintains a copy of the ledger to prevent a single point of failure, and all copies are updated and validated simultaneously. In the past, blockchains were commonly associated with digital currencies, and Bitcoin in particular. Today, blockchain applications are being explored in many industries as a secure and cost-effective way to create and manage distributed database and maintain records for digital transactions of all types. The blockchain works in a certain manner. A blockchain ledger consists of two types of records: individual transactions and blocks, and where the first block consists of a header and data that pertains to transactions taking place within a set time period. The block's timestamp is used to help create an alphanumeric string called a hash. After the first block has been created, each subsequent block in the ledger uses the previous block's hash to calculate its own hash. Before a new block can be added to the chain, its authenticity must be verified by a computational process called validation or consensus through all the network of miners. At this point of the blockchain process, a majority of nodes in the network must agree the new block's hash has been calculated correctly. Consensus ensures that all copies of the distributed ledger share the same state. This is a key idea made by Satoshi Nakamoto when he wrote the paper of peer-to-peer, where he said basically that this blockchain is protected by all the honest miners, and only it's able to be corrupted by an attacker that can surpass the consensus, which is highly difficult and unlikely. Once a block has been added, it can be references in subsequent blocks, but it cannot be changed. If someone attempts to swap out a block, the hashes for previous and subsequent blocks will also change and disrupt the ledger's shared state. When consensus is no longer possible, other computers in the network are aware that a problem has occurred, and no new blocks will be added to the chain until the problem is solved. Typically, the block causing the error will be discarded and the consensus process will be repeated. Blockchain platforms can be either permissionless or permissioned. In a public permissionless blockchain like Bitcoin, every node in the network can conduct transactions and participate in the consensus process. In a private permission chain like multi-chain, every node might be able to conduct transactions, but participation in the consensus process is restricted to a limited number of approved nodes. Choosing which consensus algorithm to use is perhaps the most important aspect of selecting a blockchain platform. There are 4 standard methods blockchain and other distributed database platforms use to arrive at that consensus. Generally, public platforms choose algorithms like proof of work because they require a lot of processing power to compute, but are easy other network nodes to verify. Proof of work algorithm, practical Byzantine fault tolerance algorithm, proof of stake algorithm, delegated proof of algorithm are also uses for actually verifying the nodes. Although Bitcoin is currently the most visible use of blockchain, it can be used the same way in any other distributed database. In 2016, the online retail company Overstock.com used blockchain to sell and distribute more than 126,000 company shares, making the first time a publicly traded company used blockchain to support stock transactions. R3, a global consortium of financial institutions, also uses blockchain to record, manage, and synchronize financial information using blockchain APIs for specific platforms. We are now seeing the increasing use of blockchain in the KYC procedures of many different banks or KYC service providers. Today, banks and financial institutions across the globe are exploring how they can use blockchain to improve security. Other industries, including healthcare, government, and technology, are investigating how they can use blockchain to enable secure exchange of data, such as personal health information, digital assets like downloaded entertainment, and real estate needs. Manufacturing and other similar businesses are also see the potential to leverage blockchain to manage smart contracts, as well as track materials as they move through their supply chain. We will explain smart contracts in more detail in a future ICO webinar. Experts cite several key benefits to using blockchain. Security is considered one of the major advantages with this technology. It is almost impossible to corrupt a blockchain because information is shared and continually reconciled by thousands, even millions of computers. And blockchain has no single point of failure. If one node goes down, it's not a problem because all the other nodes have a copy of the ledger. On the other hand, experts say blockchain also has potential drawbacks, risks and challenges. With public blockchains, there are questions about trust and who is responsible should a problem arise. With private blockchains, there are questions about whether organizations are capable or willing to invest in the infrastructure for IT chargeback. An accounting strategy that will apply the costs of IT services, like database transactions, to the business unit which they are used. The distributed ledger technology is one of the most relevant aspects of cryptocurrencies. As we said, this technology is going to be part of key services such as insurance, banking, and even KYC and compliance procedures. Distributed ledger technology is a digital system for recording transactions of assets in which the transactions and their details are recorded in multiple places at the same time. Unlike traditional databases, distributed ledgers have no central data store or administration functionality. The ledgers, which are essentially a record of transaction and similar data, have existed for millennia in paper form. They became digitalized with the rise of computers in the late 20th century. Although computerized ledgers generally mirrored what once existed on paper. However, throughout history, a central authority needed to validate the authenticity of the transactions recorded in the ledgers. For example, banks need to verify financial transactions. Now, in the 21st century, technology has enabled the next step in record keeping with cryptography. Advanced algorithms, stronger compute power, and near ubiquitous computational power, making the distributed ledger an increasingly viable form of record keeping. Blockchain, which bundles transactions into blocks that are chained together and then broadcasts them to the nodes in the network, is probably the best known type of distributed ledger technology. Distributed ledger technologies have the potential to speed transactions because they remove the need for a central authority and intermediaries, reducing costs and increasing efficiency. Experts also believe that a distributed ledger technology is much more secure because each node of the network holds records, thereby creating a system that is more difficult to manipulate or successfully attack. Others also consider a distributed ledger a much more transparent way of handling records because of the information is shared and thereby witnessed across the network, which reduces the risks of hacking attacks. Excuse me. There's much more of the early interest in the distributed ledger technology has been around its application in financial transactions. That's understandable, considering that cryptocurrencies gain worldwide use. while also simultaneously providing that distributed ledger technology can indeed work. Banks and other finance-related institutions became early innovators in this space as well. However, distributed ledger technology proponents say digital ledgers can be used in multiple areas, including government and business dealings, in addition to financial transactions. Experts believe digital ledgers can be used in tax collection, property deed transfers, social benefits distribution, and even voting procedures. They also say DLT, or distributed ledger technology, can be used to process and execute legal documents and other similar exchanges. Tax collection represents the biggest challenges for cryptocurrencies, as it represents one-third of financial transactions in developed country economies, but need to be converted into fiat currencies for the government to accept them, which, with the high volatility of the value of cryptocurrencies, represents an exchange rate risk that is difficult to assess. Some believe that individuals can use this technology to hold and better control personal information, and then selectively share pieces of those records when needed. Use cases here include individual medical records and corporate supply chains. Additionally, proponents say digital ledgers can help better track intellectual property rights and ownership of art, commodities, music, film, and more. Interestingly, Monero, an alternative cryptocurrency or altcoin, has been spearheading the application of cryptocurrencies in the purchasing of music and related products already active and available to the product. So what is the legal treatment? Due to the increasing importance of cryptocurrencies, business and individuals have been concerned about the laws and regulations surrounding cryptocurrencies and if there are any specific laws currently applying to cryptocurrencies or ICOs. Obviously, in an ever-dynamic world with day-to-day changes in legislation, it's difficult to be certain of the current status of cryptocurrencies in each country. Nevertheless, we will try to provide you with a glimpse of what actions have been taken so far by the regulators, if any. Importantly, in many countries, cryptocurrencies are not treated as currency, but as an asset. Most recently, the IRS has issued a statement related to the treatment of cryptocurrencies, where it explicitly states that virtual currencies are treated as property for federal U.S. tax purposes. General tax principles that apply to property transactions apply to transactions using virtual currency. Among other things, this means that wages paid to employees using virtual currency are taxable to the employee. It must be reported by an employer on a Form W-2 and are subject to federal income tax withholding and payroll taxes. Paying using virtual currency made to independent contractors and other service providers are taxable, and self-employment tax rules generally apply. Normally, payers must issue Form 1099. The character of gain or loss from the sale of or exchange of virtual currency depends on whether the virtual currency is a capital asset in the hands of the taxpayer. A payment made using virtual currency is subject to information reporting to the same extent as any other payment made in property. In North America, all of the countries are permissive. For example, in the US, the transactions performed in cryptocurrencies, as we already mentioned, are generally taxed. Cryptocurrencies have also been subject to SEC regulations. We will explain these in more detail in a different webinar on ICOs. But certainly is important. Moreover, in the state of New York, subject to certain exceptions, anyone engaging in any of the following activities is required to obtain a BIT license: virtual currency transmission, storing, holding, or maintaining custody or control of virtual currency on behalf of others, buying and selling virtual currency as a customer business, performing exchange services as a customer business, controlling, administering, or issuing virtual currency. A consumer does not need to obtain a BIT license in order to purchase goods or services with virtual currency, and merchants are not required to apply for a license to receive cryptocurrency either as a way of payment. The fee for this license is $5,000. Nevertheless, compliance requirements in accordance with the regulations for the BEAT license raise operational expenses from 50 to 100,000 US dollars. Reason enough for many cryptocurrency business to move their companies elsewhere. However, in Central and South America, a few governments have taken different approaches or absolutely none. In Central America, no country has officially permitted, regulated, or prohibited cryptocurrencies. In South America, Ecuador has expressly prohibited the emission, production, and use of cryptocurrencies. However, it has stated the creation of its own digital currency backed by the Ecuadorian Central Bank. Along the same lines, Bolivia has also expressly prohibited cryptocurrencies, but differently than Ecuador, has no foreseeable plans to use its own cryptocurrency. On the other hand, Chile, Peru, Uruguay, Paraguay, Venezuela, Suriname, and Guyana have an unclear status with no public statements or regulations regarding cryptocurrencies. Venezuela's president has already stated that he is intended to issue its own cryptocurrency, but nothing official other than that has been made public. Argentina, Brazil, and Colombia, from the other side, are permissive of cryptocurrencies and related transactions, and more specifically, Argentina and Brazil do tax activities related to Bitcoin, clearly through the application of income tax and value-added tax, VAT. Lastly, in the region, Colombia remains with an unknown tax treatment on cryptocurrencies. Moving on to the European and Eastern European region, most of the countries are permissive of cryptocurrencies, with the exception of Bosnia and Herzegovina, Montenegro, Albania, Macedonia, Kosovo, Serbia, Romania, and Moldova. Only Russia presents itself more actively involved in the attempt to regulate cryptocurrencies and apparently making an effort to implement its own. No concrete regulation has been approved yet. However, it will be interesting to see further developments. Where cryptocurrencies are permitted, certain regulations regarding anti-money laundering, counterterrorism financing may apply. Two jurisdictions stand out as more lenient towards cryptocurrency, Malta and Gibraltar. Malta is going to implement a sandbox test within the gaming authority to test the economic impact of regulating cryptocurrencies. Gibraltar, on their side, has proposed a bill to its parliament for a license scheme to be applicable from early 2018 if passed. As for the African continent and the Middle East, most of the countries are neutral in terms of cryptocurrencies. Nevertheless, Israel, the startup nation, is expecting to have a report by a committee confirmed by the Israeli Securities Authority at the end of this year, where the commission will evaluate the financial impact of ICOs and the legitimacy of Bitcoin, among other aspects. Likewise, the South African government is another active participant in looking into what regulations of cryptocurrencies, or the lack thereof, will mean for the country. With attempts to implement sandbox testing within the South African Reserve Bank, South Africa is definitely curious but hesitant at this stage. Moreover, the United Arab Emirates is, as referred to above, has taken important steps towards regulating cryptocurrencies. Currently, it does not regulate cryptocurrencies as such, but it does regulate firms that issue cryptocurrencies as securities on a case-by-case basis. In Asia, cryptocurrencies, we're going to talk about Oceania. In Asia, cryptocurrencies have been widely accepted, except for one of the most important markets in the region, China. The People's Bank of China, the Ministry of Industry and Information Technology, the Ministry of Industry and Commerce, the Banking Regulatory Commission, and the China Insurance Regulatory Commission issued a joint statement where they declared the fundraising through cryptocurrencies as illegal in the territory of China, and it prohibits any organization or individual engaging in unauthorized issuance of tokens for financing purposes. This prohibition is extended to financial institutions and other non-bank payment institutions such as WeChat, one of the biggest communication and social network platforms in China that currently also handles money transactions between users. Nevertheless, Hong Kong has a more flexible approach towards regulating cryptocurrencies. According to an official announcement from the Securities and Futures Commission of Hong Kong, Cryptocurrencies are not securities by nature. However, under ICOs and other collective investment schemes, might be regarded as securities and therefore be regulated on the SFC. On the other hand, another important market in the region, Japan, has recently issued amendments to its regulations aimed at registering cryptocurrencies issuers since April this year, through the amendments to the Payment Services Act, whereby it considers cryptocurrencies as a prepaid payment instrument. Last but not least, in South Asia and Australia, cryptocurrencies are being regulated through different instances, such as tax legislation and anti-money laundering and counterterrorism financing regulations, such is the case of Australia, Singapore, and the Philippines. Separately, in Indonesia, the Bank of Indonesia has clearly stated that cryptocurrencies are not a legal payment method, without regulating expressly. Singapore, specifically, has issued regulations to regulate cryptocurrency-based business, but not the cryptocurrency itself, generally aiming at regulating ICOs under the same line of the US. Nevertheless, there are certain exemptions and regulatory sandbox licenses that can be applied for in Singapore. Conclusively, the outlook of cryptocurrencies from a regulatory approach is uncertain. However, countries are inclined to take 4 different actions. 1, assess the impact of regulation on cryptocurrencies. 2, tax the operations. 3, insert them into the category of security or commodity. And 4, take no action at all. At Eltoma Corporate Services, we can assist you with any specific inquiries that you might have in this regard. Our team of professionals is continuously revising relevant information in this field and is able to assess your business situation with the most up-to-date and accurate information. Eltoma Corporate Services aims to provide our client base with a personal, cost-effective, and efficient service. Our client base has substantially and internationally grown over the years, yet we still retain our core values of professionalism, cost efficiency, and personal service. Our corporate services include company incorporation and maintenance, banking and finance, bookkeeping and accounting services, tax planning, IT and web services, software for business, web and marketing services, legal services, immigration services, license and permits, licenses specifically under this topic in Singapore. We also promote recruitment services. We have a special team of professionals at Eltoma Recruitment. You can post your job offers or see the actual vacancies at eltomarecruitment.com. Due to the ever-increasing importance of CFC regulations for business-related purposes in Cyprus, we have identified how we can help. We have expanded our services portfolio into property. We have a number of unique properties on the market in Cyprus for investment opportunities. Should you wish to find out more about any of the properties on screen, you can do so by entering your email address in the chat box on screen, and one of our property agents will revert to you shortly. Alternatively, you can visit eltomaproperty.com. We look forward to your comments and questions. You can always contact us at info@eltomaglobal.com or visit our offices in Cyprus or Singapore, or call us to the numbers showing on screen. Thank you very much for your attention, and I hope to see you on the next webinar or on ICO or any other related topics.